Imagine this. You finally hit $20,000 in savings. Not inherited, not gifted, earned. 3 years of saying no. 3 years of skipping upgrades. 3 years of discipline. And suddenly, something changes. Not your bank account, your thinking. Because the most dangerous moment in your financial life is not when you're broke. It's when you're almost successful. The psychological pivot. When you reach a meaningful savings milestone, your brain tries to cash it in emotionally. It says, you've earned this. You can relax now. Upgrade your life. What's the point of money if you don't enjoy it? And that's how $20,000 turns back into $3,000 in less than a year. Wealth isn't usually destroyed by emergencies. It's destroyed by celebration. Step 1. Eliminate guaranteed losses. Before investing a single dollar, ask one question. Do you owe money at high interest? If you're paying 18%, 20%, 25% on credit cards, you are not investing. You are bleeding. If the market earns 9 to 10% historically, and you're paying 22% interest, you are mathematically choosing to lose 12% per year. That's not strategy. That's denial. Debt above roughly 7% kill it. Because a guaranteed 22% return from paying off debt beats a hopeful 10% return from investing every single time. Step 2. Build financial shock absorption. Once debt is gone, most people rush to invest everything. Mistake, because life does not care about your portfolio. Cars break, jobs disappear. Medical bills show up uninvited. If you don't have 3 to 6 months of essential expenses in cash, you are one inconvenience away from undoing all your progress. An emergency fund isn't there to grow. It's there to prevent panic. Keep it in a high-yield savings account. Safe, liquid, boring. Boring is good. Step 3. Turn savings into a wealth machine. Now, and only now, you invest. If you qualify, prioritize a Roth IRA. Why? Because growth inside it is tax-free. A small contribution in your 20s can quietly multiply for decades without the government taking a cut. But here's where people sabotage themselves. They start hunting the next big stock. They scroll forums. They chase tips. They think complexity equals intelligence. It doesn't. Broad market index funds have quietly outperformed most active investors for decades. Instead of trying to outsmart the market, own the market. Consistency beats cleverness. The real power, time. Let's remove hype and look at math. If $20,000 compounds around 10% annually for 30 years, it doesn't double, it doesn't triple, it grows into several $100,000. Not because you were brilliant, because you waited. Compounding rewards patience, not excitement. And here's the part people ignore. Waiting 5 years to start can cost you 6 figures in lost growth. Procrastination isn't neutral, it's expensive. What destroys most people? Not crashes, not recessions, lifestyle inflation. You hit $20,000 and suddenly the apartment feels small. The car feels old. The vacation feels necessary. Upgrades feel harmless. But every additional $300 to $500 monthly expense isn't just $300. Invested over 30 years, that same money could become hundreds of thousands of dollars. Most people don't go broke dramatically. They just upgrade themselves into mediocrity. Timing is a trap. People love waiting for the right moment. The problem? Markets spend most of their time near highs. If you wait for perfect conditions, you'll mostly wait. History shows that missing just a handful of the best recovery days could cut long-term returns dramatically. Time in the market beats timing the market every time. Age strategy. Condensed. Framework. 20s. Heavy stock allocation. Max retirement accounts. Use time as your advantage. 30s. Increase emergency buffer. Balance growth with stability. 40s plus. Protect gains gradually. Shift allocation as time horizon shortens. The strategy changes not because stocks become evil, but because your recovery time shrinks. Underrated investment.
your income. Sometimes the highest return isn't in the market, it's in your skill set. If a certification or credential meaningfully increases income, the ROI can dwarf market returns. Higher income fuels higher investing capacity. The fork in the road. From $20,000, there are two directions. Convert it into a long-term asset base that compounds quietly. Convert it into visible upgrades that depreciate loudly. The difference isn't intelligence, it's restraint. Wealth is rarely built through genius, it's built through repetition. Automate investments, control lifestyle creep, ignore noise, stay consistent for decades. That's it. Boring wins, and boring, over time, becomes extraordinary.